Hi everyone. In this video, we'll continue working on the Chapter 8 review exercises that we started in the last video. In the last video, we completed questions number 1 and 2, and in this video, we're going to start with question number 3, which is another depreciation problem. On September 1st, 20X1, Mason Legal Services purchased a vehicle to be used 100% in the business. The vehicle cost $84,500. Mason estimates that the company will use the vehicle for 5 years and that the vehicle will be driven 90,000 miles during the 5-year period. The company estimates that the vehicle can be sold at the end of 5 years for $8,000. And then it gives actual miles driven in 20X1 and then in the following year 20X2. So part A says write the journal entry to record depreciation expense for the year ended December 31st, 20X1 using the units of production method. And again, this study guide is a review of skills that you have already learned. This was discussed thoroughly in the instructor video lectures for Chapter 8, as well as explained beautifully in the textbook. So you should be able to handle this. Go ahead and write the journal entry, and then start the video again to check your work. As you have previously learned, the formula for calculating units of production depreciation is really very similar to straight line depreciation. It's cost minus salvage value, but instead of dividing by the life of the asset, instead you divide by the total units that is estimated for use of the asset throughout its life. In this case, it's a vehicle, and it's estimated to be driven 90,000 miles over its usefulness to the company. So $84,500 minus $8,000 divided by 90,000 miles equals depreciation expense of 85 cents per mile. And then you are given actual miles driven during X1 and X2. So the journal entry then for December 31st, 20X1 is as follows. First, calculate depreciation expense for 20X1. That's the 6,300 miles actually driven times 85 cents per mile, and that equals $5,355 of depreciation expense for X1. Debit depreciation expense vehicles, credit accumulated depreciation dash vehicles for $5,355. Part B says, write the journal entry to record depreciation expense for the year ended 20X2. And there's a hint about rounding. It says, round depreciation expense to the nearest dollar. Go ahead and write that journal entry. And then start the video again to check your work. So 20X2 depreciation expense is $13,345. That's calculated by multiplying the actual miles driven of 15,700 times 85 cents depreciation expense per mile. And that equals 13,345. So debit depreciation expense dash vehicles, 13,345. And credit accumulated depreciation dash vehicles, 13,345. Question number 4 says that we're going to use the same facts as in question number 3. It's this vehicle that was purchased. But instead of using units of production depreciation, we're going to use double declining balance method to calculate depreciation expense. So number 4A says write the journal entry to record depreciation expense for the year ended 20X1. And it says to be sure to round depreciation expense to the nearest dollar. And Part B says calculate the expense for 20X2 and write the journal entry. So go ahead and calculate depreciation expense for 20X1 and 20X2 using the declining balance method to calculate the depreciation. Then go ahead and write the journal entry for Part A and Part B. Now let me give you a big hint. We did not own that vehicle for the whole year in 20X1. We purchased the vehicle and began using the vehicle on September 1st, 20X1. It is now December 31st, 20X1. So we've only used that vehicle in 20X1 for 4 months. That's a huge hint. Go ahead and do your calculations for double declining balance. Write the 2 journal entries, then start the video again to check your work. As explained in the prior lecture videos for Chapter 8, and as explained in the textbook, you do not consider salvage value when you're calculating depreciation expense under the double declining method, balance method, until the last year. That's when you use the salvage value. For straight line and units of production, you use salvage value at the very beginning of the calculations, but not for double declining balance method. That's number 1 to remember. Number 2 to remember is you need to figure out the percentage to use in your calculations. And it's double the declining balance. Double means the percentage that you use is double the percentage that you would use for straight line. So for a 5-year asset, and that's what this asset has, it says it's got a 5-year life. For a 5-year asset, the straight line percentage would be 20% per year. 100% divided by 5 years equals 20% per year. So double that. Therefore, double declining balance percentage is 40%, and we're going to calculate the expense every year using 40%. Now, the next thing is that you need to multiply that percentage times the declining balance of the book value of the asset. Every year, the book value gets smaller and smaller and smaller. Doesn't matter what method you're using, every year the book value gets smaller because the book value is calculated as cost minus accumulated depreciation. As we accumulate depreciation expense each year, accumulated depreciation gets bigger. Therefore, the book value gets smaller. So, double declining balance means you take double the depreciation rate that you would, the percentage that you would use under straight line, times its declining balance. If we do not use salvage value, then at the beginning of year 1, the book value of the asset is the same as its cost, which was $84,500. Remember, ignore salvage value until you get to the last year under double declining balance. So in year 1, we're going to start out with the cost of the asset, $84,500, multiply it times 40% to calculate a full year's worth of depreciation of $33,800. But we did not own and use this asset for the full year in year 1. We only used it and owned it for 4 months, September, October, November, and December. So take the full year's worth of depreciation expense times 4/12, and that equals the current year, year 1 depreciation expense of $11,267. Accumulated depreciation is the prior year's accumulated plus the current expense. Well, in the first year, there is no prior year's accumulated, so accumulated depreciation at the end of year 1 is equal to the expense for year 1, $11,267. And the book value is cost minus accumulated, or $73,233. Notice how the book value declined from $84,500 down to $73,233. Double declining balance. So you use that $73,233 ending book value at the end of year 1 and at the beginning of year 2, multiply it times the same 40%, and that calculates depreciation expense for year 2 of $29,293. For this problem, you could end right there, because you don't have to go on to future years' calculations. I went ahead and said, well, after year 2 then, the accumulated depreciation grew to $40,560. That's prior accumulated plus current year expense. And the book value then declines even further. $84,500 of cost minus $40,560 of accumulated equals the ending book value of $43,940. And if we had to calculate year 3 depreciation expense, we would start out with $43,940 in this block right here. So now compare your depreciation expense for year 1 and year 2 and fix it if it's not right, because you can't possibly get the journal entries correctly written if you have not correctly calculated the depreciation expense for each year. And then go ahead in number A, use $11,267 of depreciation expense to write your journal entry. And in year 2, use the $29,293 depreciation expense to write your journal entry. For the year ended X1, debit depreciation expense dash vehicles, $11,267, and credit accumulated depreciation dash vehicles, $11,267. Depreciation expense for year 2 we had already calculated as $29,293, so debit depreciation expense dash vehicles, $29,293, and credit accumulated depreciation dash vehicles, $29,293. Well, that's all for this video. In our next Chapter 8 study guide video, we will continue working the review exercises for Chapter 8. See you next time.